Have you ever wondered how sophisticated investment vehicles, like hedge funds, navigate the inherently volatile and complex landscape of global financial markets, all while aiming to deliver consistent returns? Hedge funds extensively use derivatives for risk management because these instruments offer unparalleled flexibility and precision in isolating and mitigating specific market exposures. This strategic application allows them to protect capital, manage volatility, and maintain specific risk profiles that align with their investment objectives, making them essential tools for sophisticated portfolio construction. The core mechanism enabling derivatives to serve as powerful risk management tools lies in their ability to derive their value from an underlying asset, index, or rate, without requiring direct ownership of that asset. This allows hedge fund managers to create highly customized exposures or hedges. They can effectively separate different risk factors, such as interest rate risk, currency risk, or market directional risk, and address each one with a tailored derivative instrument. Furthermore, derivatives often provide a cost-efficient way to gain or offset exposure compared to transacting in the physical underlying assets, offering significant leverage that, when managed prudently, enhances hedging efficiency. For hedge fund managers, employing derivatives in risk management involves a continuous process of identifying potential market vulnerabilities and selecting the most appropriate instruments to counter them. This could mean using futures contracts to hedge against broad market downturns, employing options to cap downside risk while retaining upside potential, or utilizing interest rate swaps to manage exposure to fluctuating borrowing costs. They dynamically adjust these positions as market conditions evolve, ensuring their portfolios remain resilient to unexpected shifts and maintain the desired risk-return characteristics. The key is to match the derivative's payoff profile to the specific risk being managed. A key advantage is the ability to construct synthetic positions, which replicate the payoff of an asset or strategy without holding the actual asset. This can be crucial for managing liquidity or accessing hard-to-reach markets. Derivatives also allow for sophisticated strategies like tail risk hedging, where out-of-the-money options are used to protect against extreme, low-probability market events, offering substantial protection for a relatively small premium. Understanding and managing basis risk, the imperfect correlation between a hedged asset and its hedging instrument, becomes paramount for effective derivative use. Ultimately, the strategic use of derivatives empowers hedge funds to transcend simple asset allocation and engage in active, granular risk management. By allowing for precise control over various risk factors, derivatives enable these funds to adapt quickly to changing market environments, protect their underlying investments from adverse movements, and construct portfolios that are both robust and capable of pursuing specialized return opportunities, thereby reinforcing their overall financial stability and performance.